Thank you, Anne. Hi, everyone. My name is Sarah Sedlak. I am the Vice President of Business Development for SC&H, and I'm here with Pam Chelden, who is the Director of our Accounting Solutions practice. We're glad to be here. Thank you for having us, and we are recording this for posterity, so you can always go back and look up information or reach out to us if you have additional questions. SC&H, briefly, we are a CPA management consulting firm. We're based here in Baltimore. We work with a lot of TEDCO companies, a lot of growth stage and startup companies, providing outsourced accounting, audit, tax, technology, and risk services, risk advisory services. So the presentation today is Accounting 101. We're going to talk about the basics. This is the first in a series of, I believe, what will be at least 5 or 6. Next month, we're going to be doing a Tax 101, and then we'll start to get into some more complex, higher level conversations that will be interesting to you as you grow your company. Pam, I'm going to toss it over to you to run. I'll drive the train, but just so everyone's aware, Pam's background, and Pam, you can introduce yourself, but as the director of our outsourced accounting practice, Pam does provide bookkeeping, controller, and fractional CFO services to startup to mature companies. We have a lot of technology, biotech, and life sciences clients, so we're familiar with the outside funding, investor funding, grant funding model, and we're going to talk today a little bit about how to set your company up at the early stages so that you've got a scalable foundation, a solid foundation on which to grow. Pam, anything you want to add before we dive in?
Nope, that sounds good. Ready to get started.
Awesome.
Do you want to advance the slides?
I will. And anyone at any point, if you can't see or can't hear, chat, because I do have the chat box open. So here's what we're going to cover today. We did our quick intro. We're going to go through some basics on the accounting systems and just, how to set your company up. We'll talk about the chart of accounts and go through some other basic accounting terms that y'all are going to want to be familiar with. Don't be afraid to raise your hand and ask a question if you've heard something thrown around that you're not sure what it means. Like, this is a safe space, so we'll answer your questions. We'll talk about your financial statements, what they should look like, and what you should be looking for from them. A little bit about grant reporting, and then we'll start to talk a little bit about when do you think about engaging an accountant and what should they do for you once you get past that point of doing it yourself. A little bit about us. As we said, we're here in Baltimore. We're 350 employees at about this point. And I'm happy to say we just found out yesterday that we are on the Inc. magazine's Best Places to Work for the 5th year in a row. So what that means for you all is we have very little turnover. So if you do decide to use us as an advisor in any capacity, you're working with a good team. Here's a list of services that we offer. And then let's dive into the accounting systems and business basics. Pam, take it away.
Okay, sounds good. As Sarah mentioned, I'm the Director of Accounting Solutions here at SC&H, where we provide outsourced CFO, controller, bookkeeper level services for small to mid-sized companies using all cloud-based technologies. My experience, just briefly, so that you know where I'm coming from, I started my career with KPMG in the Charlotte, North Carolina office, and I've spent the last 20 years as a CFO, one for a logistics company and one for an ed tech company that also had an investment from TEDCO. So I am intimately familiar in working with TEDCO. So I've been with SC&H now for about 2.5 years and driving this practice to provide kind of this outsourced consultative accounting solutions for our clients. So one of the things that we created was the startup business checklist. And so if you're getting your business going, these are some of the things that hopefully you've either done or that you need to do, which is register your business domain. You'll need to make sure that you've applied for an EIN, your taxpayer ID. You need to incorporate your business, whether that's a C Corp, an S Corp, an LLC. There's different structures that hopefully an attorney or a tax advisor can help you make those decisions. You'll need to apply for relevant licenses and permits. If you want to start payroll, you'll need to file for various state tax accounts to get that started. You'll need to open a business bank account. I highly encourage you to separate your personal bank account from your business bank account. Same with credit cards. It's just easier to keep track of it separately. And then set up basic accounting and chart of accounts, which is what we're going to talk about today. You also will need to set up a payroll service if you plan to pay payroll, like ADP or Rippling. We'll talk a little bit more about that later. And then secure any necessary trademarks, patents, license agreements. Typically, that's what you're in the business of doing and promoting. So again, I think an attorney is a good consult there. You can flip to the next slide. So accounting systems. This is kind of gives the evolution of accounting systems. So you can start with Excel. It's easy to track in Excel. It's very simple. You can keep track of, money that's coming in and money that's going out. It is an organized fashion to do that. However, you cannot create a balance sheet or an income statement easily. So it's good in the very beginning to help you keep track of kind of business from personal activities. But at some point in time, when you need to create financial statements, you want to consider migrating to an accounting system that does that for you automatically, such as QuickBooks. And QuickBooks is a great system. It is really set up for non-accountants. It's pretty easy to navigate. It comes with a built-in chart of accounts. We'll talk a little bit more about that later on. But it's a great kind of starter package system to get you going. It comes, it will allow you to quickly create your financial statements, which is something you can't really do from Excel. The next evolution in accounting systems would take you to an ERP system. Sage Intacct is one of those systems. ERP might sound scary to some people, enterprise resource planning system. I think Sage Intacct is really uniquely positioned to help small to mid-sized businesses because it's pretty easy to use. It's pretty intuitive, just like QuickBooks is. It takes a little bit more time to actually get it set up and implemented, whereas QuickBooks, you can kind of start it yourself. Sage Intacct requires help and assistance to get it set up and running, but the cost of running it on a monthly basis is comparable to QuickBooks. So that's really advantageous to small businesses that need to be a little more cash aware and cash sensitive. But what it does is it allows you to actually keep track of your data either departmentally or by location. It keeps tracks of different dimensions. And so if basic balance sheet and income statement, if that does it for you, then QuickBooks is great. But once you need to start tracking how much you're spending for marketing or for production, or maybe you've got multiple locations and you've got different directors or managers who are responsible for a particular location, and you need them to be held accountable to a particular P&L, you need to be able to generate a P&L for that location or for that department. And that's where a system like Sage Intacct can help you keep track of that. So it just allows for much more robust tracking.
Pam, one thing to add there with something like Intacct, like a more robust ERP, we see a lot of companies, for those of you on this call right now or watching later, the trigger for this is when you have multiple assets in your development or in your commercial revenue stream, medical devices or softwares or whatever it is that you're working on, or if you have multiple sources of money coming in the door, different investors, different grants, when you need to be able to track the cost in and out related to those different assets or those different revenue streams. That's where these multiple dimensions are going to come into play. So if you're asking yourself, when do I need this? That's when you want to start having that conversation.
Perfect. You can advance the slide. Yep. Okay. So I just want to touch on basic financial reports. And this is Accounting 101. So I'm going to just really start with the basics here. You've got a balance sheet, an income statement, and a cash flow statement. Those are the three basic primary reports that if you're talking to anyone about your business, you need to talk to investors or to bankers or anybody else that wants to help you with your business, consultant that you want to hire to help you with the business. They're typically going to ask to see your balance sheet and your income statement. So you need to be able to be prepared to share that with them. And then I just want to cover at kind of a high level, what is a balance sheet? What is a P&L? So a balance sheet is going to show you what you own, what the company owes, and then how much the shareholders have invested. So it has your assets, your liabilities, your stockholders' equity, and it's as of a certain date. So any point in time, we could do a balance sheet as of today, May the 11th, and you would be able to identify how much cash you've got, how much accounts receivable you have, how much inventory you have, accounts payable, all those things as of a certain date. Typically, you do it at month end. And then most people are interested in certainly your year end, which could be 12/31, or it could be another date. It could be, you could have a different fiscal year end from the calendar year end. Although most companies, are calendar year end. So you do a balance sheet as of 12/31/21. Right now we're working on generating financial statements for our clients as of April. So we use April 30th, 2022 as a date to generate the balance sheet. The income statement is going to show a company's revenues and expenses and net income or loss for a particular period. So it can be for 1 month, it can be for 6 months, it can be for 12 months. So typically when you see an income statement, it will say for the 12 months ended 12/31/21, or it could be for the 4 months ended April 30th, 2022. So it's important to know that it's as of a balance sheet date and then for a particular period on the income statement. Same thing for the cash flow statement is for a period of time, whether it's a month, 6 months, or 12 months, and it shows the changes in the balance sheet accounts and how that impacts your cash. It's broken down into operating, investing, and financing, and again, it's for a particular period. We will touch on these a little bit more in detail later. These statements are also typically what's required if you have to have an audit or you have audited or reviewed financial statements. You're going to show a balance sheet, an income statement, a cash flow statement. Sometimes you might have a stockholders' equity statement, and then you'll have footnotes that go with that. But that's usually, further down the evolution of your business and your business needs when you need an audit or review. Prior to that, just having a balance sheet and an income statement gets you into the conversation with investors or anybody else who's interested in helping your business grow. Okay. So some other financial terms that I wanted to just kind of touch on that I think are important that you need to be aware of and be able to have conversations with investors or, again, anyone else that wants to understand where you are, where your business is in the life cycle. So EBITDA is a really important term. It sounds kind of funky, but it stands for earnings before interest, taxes, depreciation, and amortization. And it's a really important term because it's what's used, when you talk with investors or you're looking to value your business or maybe sell your business, they typically talk about it in terms of a multiple of EBITDA. And EBITDA, even though it's a kind of a long name, earnings before interest, taxes, depreciation, amortization, what they're trying to get at is your operating cash flow. How much is your business really kicking out from its core operations? And that's what EBITDA represents. So just want to make sure everybody understands EBITDA and how to calculate it. And a little bit later on, I'll kind of show you the income statement is the primary place where you start to figure out your EBITDA. You kind of start with your earnings or your net income, and you back into these other numbers. The other thing that you might hear tossed around is your burn rate. This is important for like early stage startup companies. You're typically going to be burning through money. It means you're spending more in cash than you're bringing in. Because you're investing in the product, you're investing in the services, you're developing something, you're trying to expand into different regions, and that takes an investment, that takes money, and you're typically going to spend more than what you're bringing in. So it's really important to understand what your burn rate is. It's a measure of negative cash flow, and it's a net number. It is how much cash are you bringing in, how much cash are you spending, what's that, and how much are you burning. It's typically discussed in terms of a monthly burn rate, but you usually calculate it on an average. So you might look like at your 6-month trended average for burn. And just kind of as an example, let's say an investor is looking to give you $1 million. Let's say you have $200,000 in the bank on your balance sheet, and your current burn rate is $100,000 a month. Then you have about 12 months of runway until you run out of money. So that's how burn rate and runway are kind of connected. And you might hear those questions coming from investors, like, what's your run rate? Say that 3 times fast. So it's just, those are kind of connected, and it's really important to understand how much you're burning through, because, at the end of that runway, you need to have a plan. Are you raising more money? Do you expect to change your burn rate during that time period. Instead of burning $100,000 a month, do you expect to start selling the product or seeing some sales growth that's going to help bring money in, reduce your burn, extend your runway? So it's really important to kind of understand how those interrelate and to be able to talk about them. And it's, once you calculate your burn rate, it can change. It should update. You can recalculate it again next month, right? So it's a fluid number that can change based on any number of factors. The other topic that I wanted to talk about is kind of cash versus accrual. So cash basis is typically what's used when you prepare your taxes and your tax return. It helps you to minimize your taxes, but it's not really a useful way to report your financial statements accurately. So, and it's okay to have a cash basis for your tax return, but an accrual basis for your financial statements. So accruals will include things like accounts receivable and accounts payable, and it's a better representation of your financial picture. So accounts receivable means you've sold something and you're waiting for your customer to pay you money. So you haven't received the cash yet, so it's not reflected on your tax return or your cash basis statements, but you're expecting that money to come in. It's something that you have an asset, somebody owes you that money. Similarly with an accounts payable, if you've incurred a service and you know that you're going to have to pay that vendor and that invoice at some point in time in the future, it's an accounts payable today. You owe it. It should be reflected on your financial statements to give a true picture of what your financial position looks like. The other thing related to that is US GAAP. And you might have heard the terminology GAAP. It stands for Generally Accepted Accounting Principles. And that is a basic standard here in the US that CPAs and accountants understand. Anytime you have audited or reviewed financial statements, they're going to prepare them in accordance with US GAAP. There are standards that we have to follow to make sure that we are consistently reporting everything across the board, consistent with all companies, right? So it's a good measure. You can prepare financial statements using US GAAP without needing an audit or a review, right? So like we will support our clients generating financial statements under US GAAP, but they don't require an audit. But it's good to know that the statements are, full accrual basis financial statements, and they're ready for an audit if you need to have an audit at some point in time in the future. Chart of accounts. So I wanted to just cover chart of accounts. You can go ahead and advance the slide. Thanks, Sarah. So chart of accounts is an index. Let me move my screen around here. It's an index of all financial accounts in the general ledger of a company. It's just a way to keep things organized. It can be used with or without a numbering sequence. QuickBooks comes with a standard chart of accounts already baked in that you can use and you can customize. I don't believe it comes automatically with a set of numbers. I really like numbers. It makes it easier when you're trying to add up a group of chart of accounts to create your balance sheet and income statement. So I encourage it. So I just wanted to talk through kind of the logical sequence of a chart of accounts and how you might set something up. And this is the chart of accounts. There's no set rules. You can set it up however you'd like to set it up, but it makes it easier if you follow these kind of general conventions. And that is, I'm going to go through the financial reports we discussed earlier and talk about what accounts you typically will assign. So if we look at a balance sheet as an example, your assets are going to be your cash, accounts receivable, inventory, prepaids, fixed assets is just some example. And they're all typically going to start with a 1. And it can be a 4-digit number, a 5-digit number, a 6-digit number, but you're going to assign every single account is going to be like cash might be 1,000, accounts receivable might be 12,000 or 1,200. Sorry, inventory might be 1,300. So just different numbers that you might use to sequence them. And if they all start with 1, then we know they're an asset account. Liabilities will typically start with a 2, accounts payable, accrued expenses, notes payable, any debt would be a 2. And then your equity section is going to start with a 3. It's your capital accounts, your ownership accounts, members' equity if you're an LLC, and then retained earnings. And retained earnings is just your cumulative net earnings since the beginning of time. And that is part of the 3000 series. Your income statement, it continues, right? Your income statement is a different financial statement, but you'll have your revenues grouped at the top, and they're typically a 4000 series. Then you've got your cost of sales, which is going to be a 5000 series. And then you have gross profit, but gross profit is a calculation. It's a formula. It's a revenue less cost of sales, gives you your gross profit. So there's no chart of account assigned to gross profit because it is a calculation. And this is really good. I'm just going to pause here and kind of go a little bit sideways in that if you're looking at how can you improve your gross profit of your business, it's a formula, right? So you either need to increase revenue or reduce your cost of sales, and that's going to drive your gross profit and your gross profit percentage. And that's a number that a lot of investors will focus on, or other people in your business, like what's your gross profit and how can we improve it? The next item on the income statement is SG&A, which is selling, general, and administrative expenses. Those are typically in the 6000 series. I've got an example on the next slide, Sarah, if you could scoot there and then come back. I don't know if you can do that. Hopefully you can go back. But this is just kind of an example. Like this is like where everything is. Everything besides revenue and cost of sales, all of your other expenses, your salaries, your benefits, your payroll taxes, your rent, your meals and entertainment, travel expenses, telephone, utilities, insurance, everything that you want to track, all the expenses related to your business, you're going to want to have a chart of accounts for. And then you can group those into kind of summarize in different categories, but that's all your selling and general and administrative expenses. Can you kick it back to the prior slide? Thank you. So this is the next area on your income statement then is going to be your operating income, which is also kind of close to your EBITDA. So your gross profit less your SG&A gives you your operating income. And that is kind of the, almost the cash flow generation operations of your business. So it's a really good number to know. What is your operating income? What is your loss? And that can be the same or close to your EBITDA number. The next area is other income and expenses, and that is in the 7000 series. It's going to be your interest expense, your interest income, and other gain loss on sale of fixed assets. PPP forgiveness is where we coded that. So you take your operating income less your other income and expenses, and you get operating income less other income equals your income before taxes. Sorry, a lot of words there. And then you have your income taxes, but only if you're a C Corp, because if you're a flow-through entity, the company does not have individual income taxes. So if you're a flow-through entity, your net income will equal your operating income. It equals. You won't have income taxes, if that makes sense. So does that make sense? Sorry, I can't get any feedback here if anybody wants to chime in.
I think that's good. I think it's people will be able to go back. The green letters are the calculations.
Yeah.
The blue letters are the accounts and the codes. So okay. Yeah, I think it's good. It's clear how you laid it out.
Okay.
Do you want to spend any more time here, or do we cover what you wanted to cover?
I think that's good. I just kind of wanted to show some example of the types of accounts that would be included in your SG&A, your selling, general, and administrative things.
Okay.
And this is an example of the actual chart of accounts, the numbering sequence, like I talked about cash. And, a good example here on cash is you want to have a different chart of account for every single bank account that you have. You might have a bank account for operating. You might have a different bank account for payroll, or a different bank account for savings or investments. And you want to have different chart of accounts for each one of those. But on the balance sheet, they'll all roll into one line item on your balance sheet called cash. So how you should set up the chart of accounts, you should include all the accounts that are involved in your business. And every business is going to be different. So there's not a really standard chart of accounts. There's just kind of the generally accepted accounting numbering sequence. But within that, within SG&A, whatever's unique to your business that you need to track and know, how much did I spend during this period compared to how much did I spend last period? You want to be able to track those expenses and know how much you're spending. You can always add accounts. You want to make sure that you don't have duplicate accounts. Sometimes a chart of accounts, like the couple of examples we showed you here, are very small chart of accounts. Typically, it can be up to like 100. It could be 1,000. It can get unwieldy if you don't control it, because you can be like, oh, this invoice came in, I want to track it separately. So you set up a new chart of accounts, and before you know it, you've got this gargantuan chart of accounts, and it's really difficult to understand, to make sense out of it, to like try to make decisions from it, and to understand how much you're spending on things. So just be careful when you add accounts. Consider, consolidating any duplicate accounts that you might have that cover the same thing. The other really good piece of advice I can give you is to add some space between the numbers so that you can expand. Like if you want to make salaries and payroll related costs, say 6,100, then start your next section at 6,200 so that you've got, several accounts in there to use, so that you can add other benefits or other related payroll expenses as you grow. Okay, and then the chart of accounts is what's used to roll into and create your financial statements. Your financial statements is not going to list out your chart of accounts. It's going to summarize your chart of accounts into the primary categories on the balance sheet and the income statement. So this brings us all back to, and I kind of want to take you up a little bit, up to 10,000 feet, to kind of the accounting system, right? You've selected your accounting system. I encourage you to consider cloud-based accounting systems that are open to connecting with other systems. So once you've got your accounting system and your chart of accounts set up, look to how it can connect with other systems. Most of them will connect with your bank, so that you can automatically bring in activity from your bank account. And that leads to real-time reporting, real-time information. You're not having to wait till the end of the month to see how things happened. You can go in there and get it today. You can also connect your payroll system, whether it's ADP or Rippling is a tool that we use. It automatically connects and will integrate the accounting entries directly into your accounting system without manual intervention. Expense reporting, whether it's a company credit card or expense reimbursement, we use a system called Ramp. We also use a system called Expensify, and it's just, it's a great tool. That's, you can use it on your phone. It's an app on your phone that employees can use. If you're out at a restaurant, you're entertaining a customer, you get a receipt for the bill. You can take a picture of it and upload it directly to Expensify. You put the codings, who you were meeting with, it goes to Meals and Entertainment, and it'll automatically sync with your accounting system. There's just so many tools today, and they keep coming out with more and more new ones every day to make our lives easier as an accountant, but also really to give you better real-time data at your fingertips, which is really useful. We also like to use a system called Carta. It helps you with your cap table management. If you've got a Series A or a Series B, you need to keep track of your investors and who owns what. It's an excellent tool for managing that. A lot of accounting systems can connect with your CRM, Salesforce and other systems, and using Stripe to collect credit card. Again, the more that you can automatically sync that with your accounting system, the easier it's going to make your life from an accounting standpoint, as well as giving you that real-time data and information, which is really useful to help drive your business. Okay, next slide. So I just want to cover financial statements. We've talked a lot about the balance sheet, income statement, and cash flow. So the balance sheet is first up. This is just a sample balance sheet here. You've got your assets. You have cash, you have accounts receivable, inventory, you've got kind of longer term assets in your fixed assets with land, the buildings, and then you've got some intangible assets. On the right-hand side, you've got liabilities, you've got accounts payable, various other accrued expenses or other types of payables. You've got your long-term liabilities, your notes, things like that. And then you've got your stockholders' equity section, which shows how much investment you have in the business, as well as your cumulative retained earnings that you've managed to accumulate since the beginning of time, or your accumulated pulses. Either way, it keeps track of all that there. I think it's really important when you're looking at a balance sheet to take a look at your current assets and your current liabilities. This is a good example here. We have $89,000 of current assets. We have $61,000 of current liabilities. So our current assets are greater than our current liabilities. That means we have positive working capital ratio. And all that means is like you've got enough working capital in your business. And as of today, you're healthy, right? It's a good indication. It's one indication of a healthy business. Another indication is having positive stockholders' equity section. That's another indication. But it might not be true for every business, and it depends on your story and where you are in your life cycle of your business. And if you're, raising money, your current liabilities may exceed your current assets, and that's okay as long as you've got a plan. You understand your burn rate, your runway, and where you're going with the business. But these are just balance sheets, and this is how investors or other people that work with you are going to look at your balance sheet and understand, kind of where you are from a financial health standpoint. Next slide. This is a sample income statement. We've got revenues, we've got cost of sales. The difference there is going to give you gross profit. I think it's really important to understand your gross profit and what drives it. You can calculate your gross profit percentage by taking gross profit divided by revenue. And that is an important number that investors will look at. They'll compare you to other companies in your industry to see how you're doing from a gross profit standpoint. And it's nice to be able to benchmark yourself against that and then look to how to improve it. You've got your selling and operating expenses and then general and administrative expenses here. That gives you your operating income. And then we've got those other income items that we talked about, whether it's interest expense, interest income, other miscellaneous items that are not really part of the operations of your business. They fall into that category. Then we've got income tax expense and your net income. And that's the bottom line. Your net income is your bottom line. So people try, how are you doing on the bottom line? And so this is net income is your bottom line. And how can you improve or increase your bottom line? You can increase your revenue, reduce your expenses. Cash flow statement. This is my least favorite of all the financial statements because it's just not really that useful to me, but it is a required statement if you have an audit. It is a required statement if you need to give full financial statements to an investor or to a bank. You typically have to generate a cash flow statement. A lot of accounting packages will generate this for you automatically. So it breaks it down into operating cash flow, investing cash flow, and financing cash flow. And it's just like the name say, like how much cash did your business generate from operations? And this example, and I'm going to assume this is rounded to the nearest thousand, we've got $2.3 million that was generated from operations. It starts with net income and then it adds back the non-cash items. So it's a little counterintuitive here, in my opinion, but it gives you the right answer. That's how much your operations generated in operating cash flow. Investing cash flow is like you purchase some equipment. It's a long-term asset. It's going to generate value for your business over the next several years. So we don't pull that out of your day-to-day operations. We pull that out of your day-to-day operations and consider it investing. And then you've got the financing. So this is if you get an influx of cash from an investor, this is where it would go. If you're making an owner distribution or a dividend, or you're making payments on debt, this is where that would show up. So in this example, we generated $2.3 million from operations. We spent $400,000 on equipment, and we paid down some debt and we made distribution. And so we increased our cash during this period by $850,000. So that's what this cash flow statement shows you. I think a much more useful tool is a cash flow projection. And that brings in the terminology I talked about earlier about your burn rate and your runway. You have to be able to understand the cash flows of your business historically to be able to project them into the future. And that is a whole nother session, lunch and learn, that we can cover at a later date. I've done some topics and some webinars on how to manage your cash flow and how to do those cash flow projections. So it is something that an accounting system is not going to create a cash flow projection for you, because accounting systems show the history. They look backwards, they're historical. There's not a system that I'm aware of anyway that will automatically create a cash flow projection for you, because you have to make assumptions. You have to understand how much cash you expect to come in, how much cash is going to go out. I like to use the history of data to help project that or predict it. But it's something that if you get to that, it's better to have an advisor who's familiar with how to prepare cash flow projections to work with you on developing that. But I think that's a much more useful tool in the financial statement arena than a cash flow statement. But this is a necessary report. So I wanted to just briefly touch on grant reporting. There's a lot of grant funding that's available out there. A lot of our clients have been very successful at getting grants to help supplement any investor funding that's needed. So I encourage you to go research it. There's a lot of money that's available out there. A lot of our clients have been successful at getting an SBIR grant or getting grants from the NIH. It's great. It really can help supplement your investor funding. The trouble with it, it is free money, but with free money comes strings, and there's some strings attached to that. If you could advance to the next slide, Sarah. So the strings come with grant compliance and reporting. So if you're going to apply for a grant, you're going to have to build a budget. You need to understand what goes into building that budget. And then you're going to have to report on it either monthly or quarterly and annually. How much of the grant have you spent down? Are you spending it on the things that you said you would spend it on? So you need to be able to track your expenses. You need to develop a chart of accounts that can accurately track that so that you can easily report and give those reports back to the granting agency. It can really help you manage your cash burn, understanding when you can draw down on the grants. It's a great tool. I highly encourage you to seek out any grants that you can, but just understand that you'll need to make sure that you've got a system in place, or that you've got an accounting person or firm or team that can help you keep track of that as you move forward to make the reporting a little bit easier. The other area that I'll just briefly touch on is R&D tax credits, because this is tax. It's not my area of expertise, but a lot of our clients are able to take advantage of this to help reduce their payroll costs or income taxes. So a lot of our startup companies that are doing R&D, you might not pay taxes because you've got losses, which is great. But then it's hard to take advantage of a tax credit. But the R&D tax credit, you're allowed to apply against payroll taxes that you owe. So it can really help create cash savings for you. And it's fairly easy to apply and get this, but you need help from a tax accountant. And I think we're covering that in a future session with some taxes, but I just wanted to touch on that, in addition to the grants, make sure you're maximizing any R&D tax credits that are available. Engaging. So when do you want to engage an accountant? And I just wanted to talk about the different types of accountants that are out there. So you've got tax accountants, you've got outsourced accountants like me, and then you've got auditors and audit accountants. So I just wanted to talk about the different types and when you might need them. So a tax accountant, does the tax return, does the compliance aspect of it, file your tax return. What you should look for from a tax accountant is someone who's also consultative in nature and is understanding what you're trying to do as a business. They'll help you with that organizational structure, whether you're a C Corp or an S Corp, or an LLC, whether you're a flow-through entity, which is LLC, and it flows through to you personally, or whether you need to be set up as a C Corp. And it really depends on kind of your business now and where you plan to go over the next 3 to 5 years. So to help drive those decisions. And it can change over time. So a good tax accountant is going to help advise you. Maybe in the beginning, you're an LLC, but if you plan to raise money from an investor, a lot of investors will only invest if you're a C Corp. So just understanding those differences, what the tax implications are to you, and when you need to change. A really good tax consultant can help you make those decisions and make the right ones and save you a lot of money. I think that's usually what you're going to need first when you're starting out in business. You're going to need a tax accountant to help you get those tax returns filed. Right around the same time is when you might need an accountant, right? So when do you need an accountant to come in and help you? And it's when the volume of transactions exceeds your internal bandwidth to keep track of it and report it. We work with a lot of great clients who are really smart and organized and have a lot of attention to detail, and they can get in QuickBooks and keep track of things themselves. That's great. But at some point in time, you're going to be spending too much time on that and not enough time on your business and growing your business and raising money and doing what you need to do to help your business be successful. So when it becomes too much time on the accounting aspect of it is when you should bring in an accountant. There's a couple other triggers, I think, that lead to bringing in an accountant. It's like when it gets more complex, when you have grant reporting, when you need multidimensional reporting. It gets a little trickier, and you're going to likely need the help of a skilled accountant. When you're processing payroll for multiple employees, the accounting journal entry that's needed to record payroll is just not that intuitive unless you're an accountant, because you need to record it at gross, not net. And if you're just recording it on a cash basis, you're just going to record payroll at net basis, and it's not really properly reflecting your gross wages. If you need financial statements prepared on a US GAAP basis that includes accruals, you need to consider using an accountant to help you. If you feel the need to hire a full-time accountant, I would consider outsourcing. I think we're uniquely positioned to help growth stage companies because you might not be able to afford a full-time controller, a full-time senior accountant. We can help you on a fractional basis. And I think that's where it's really unique, and then we can grow with you. So I would definitely consider outsourcing as an option. And then the next phase of evolution in accounting is when you need an audit. SC&H provides tax and audit support for our clients. So an audit is if you need an opinion from a third party on the accuracy of your financial statements. And it's typically only if it's required by an investor or a bank. I wouldn't voluntarily go get an audit. They're painful and they're expensive. But a lot of times it is required in order to get money, or it's required to get a loan. So just be aware that you might at some point in time need to get an audit, and you want to be prepared for that as best you can. I think that wraps it up. Appreciate your time today. I hope that you were able to learn a few things, and that will help you be successful as your business grows. I'm always happy to answer any questions that you have either today, or feel free to reach out to me directly in the future. We'd love to help you.